TrendSynth, where AI meets insight.
For the last 3 years, corporate logic has been piped in from centralized servers, forcing companies to pay continuous API tolls for every task. In June of 2026, that architectural dependency began to disconnect as intelligence started moving directly onto the device. On June 1st, the artificial intelligence lab Anthropic filed a confidential S-1 with the SEC. Following a $65 billion funding round, the company is targeting a public debut with a valuation approaching $1 trillion. But on that exact same day in Taipei, Nvidia unveiled the RTX Spark superchip. It is a piece of consumer hardware engineered to run massive 120 billion parameter models completely locally, requiring zero cloud access. These two events represent a direct collision between peak cycle financial maneuvers and the physical engineering designed to provide a local alternative. The battle for enterprise capital is shifting away from an exclusive reliance on massive cloud APIs. The new frontline for artificial intelligence is the local agent runtime, the physical processors and operating systems living directly inside personal computers on corporate desks. The cloud API business model is currently facing extreme pressure. Corporate buyers are rebelling against metered cloud pricing, forcing a multi-billion-dollar reallocation of corporate budgets from cloud software subscriptions into local computing hardware. To maintain their cloud dominance, hyperscalers are deploying capital at a historic scale. Alphabet recently executed an $80 billion equity raise, directly funding physical infrastructure like the massive Stargate data center campus in Michigan. But there is a severe disconnect between the billions being poured into these cloud facilities and the reality facing the enterprise buyers who are expected to foot the bill. Fortune 500 finance departments are experiencing severe sticker shock. One corporate client reportedly accrued $500 million in cloud API usage fees in a single month. This bar chart details the findings of the 2026 Bain & Company Pathfinder survey, which highlights this return on investment deficit. You can see the target enterprise cost savings set between 11 and 20%. However, the realized savings for 40% of those companies sits well below 10%. This deep disparity between the capital spent on API calls and the actual efficiency gained threatens the recurring subscription model of frontier AI developers. Enterprises cannot justify these massive, ongoing API budgets to their boards. This creates a ticking clock for cloud-dependent model developers to secure their financial lock-in before corporate clients aggressively slash their spending. Anthropic's annualized revenue run rate has accelerated vertically, jumping from $87 million in 2024 to over $47 billion by May 2026. Simultaneously, the Ramp AI Index shows Anthropic officially surpassing OpenAI's corporate adoption rate, securing 34.4% of the enterprise market. This growth is driven by their highest value cohort. In under 2 months, the number of businesses spending over $1 million annually on Claude doubled. Internally, Anthropic has executed a commercial pivot. By late May 2026, the company listed 72 open sales positions, compared to 67 in research, prioritizing immediate client acquisition over pure technical development. But institutional investors analyzing their S-1 filing have identified a major structural vulnerability, a practice known as reseller accounting arbitrage. Unlike competitors reporting on a net basis, Anthropic recognizes reseller revenue on a gross basis, claiming the total customer spend as top-line revenue. Subsequent partner payouts and infrastructure fees are then categorized as costs, artificially inflating their headline revenue. Their rapid push for a public listing serves as a strategic land grab. The objective is to lock in institutional capital at a near $1 trillion valuation before Wall Street fully prices in peer-to-peer net revenue comparisons. Anthropic's $965 billion valuation relies on favorable accounting optics and sustained enterprise lock-in. Both of those pillars are under pressure as companies find cheaper, localized methods to run frontier models. The physical solution to the cloud ROI deficit has arrived, decentralizing processing logic directly to the edge of the network. Nvidia's new RTX Spark die utilizes a 20-core ARM-based Grace CPU on one side, paired directly with a 6,144-core Blackwell RTX GPU on the other. An ultra-low-latency NVLink interconnect bridges the two processors, sharing data at 300 gigabytes per second. But the most critical specification for local execution is the memory. The RTX Spark features a massive 128GB unified memory pool. This equation visualizes the memory math required to run a massive 120 billion parameter model locally. By scaling the model down to FP4 precision, which uses half a byte per parameter, the model requires a 60GB footprint. That requirement easily fits inside the laptop's unified memory. This leaves exactly 68GB of free memory, which is specifically preserved to maintain active agentic runtime states and process a 1 million token context window without crashing the system. By mathematically fitting a 120 billion parameter model onto a single laptop chip, Nvidia has physically provided a path for enterprises to bypass centralized hyperscaler APIs. To utilize this enormous local processing power, the core operating system itself must evolve from a passive tool into an active, autonomous environment. Microsoft is positioning Windows as an agentic operating system. In this environment, software applications are no longer manually launched by the user. Instead, background agents autonomously execute multi-step workflows 24 hours a day. This creates a primary security concern for enterprise IT departments. How do you run autonomous agents that read local files without leaking proprietary corporate data to external cloud models? Microsoft and Nvidia co-developed a dual security architecture to lock down local agents. First, Windows security primitives sandbox the agents, preventing unauthorized system modifications. Then, Nvidia OpenShell forces local execution, automatically stripping out sensitive personal information before any data leaves the device. For cost-conscious enterprise buyers, a closed-loop, hyper-secure local system with zero variable API costs is becoming a competitive alternative to metered cloud endpoints. The operating system itself has become a critical new moat. By securing the local control plane, Microsoft and Nvidia are positioning themselves to capture the enterprise value that model developers currently hold in the cloud. Anthropic's push for a near $1 trillion public listing is now meeting the arrival of Nvidia's hardware reality. The market structure is shifting. Raw frontier language models, once viewed as rare technological moats, are increasingly treated as interchangeable utility inputs. If enterprises can run equally capable open-source models freely on RTX Spark architecture, pure-play API developers will face significant pressure on their current pricing models. In this emerging landscape, value capture is migrating downward, away from the model layer and into the physical silicon and the operating systems that control them. Anthropic's $965 billion valuation assumes that enterprise lock-in will remain constant. But if corporate buyers pivot toward local execution, long-term stickiness will depend on controlling physical hardware and local security logic, not just cloud access. Investors and corporate strategists are now forced to recalibrate their framework for the next decade of enterprise technology. The centralized cloud model is no longer the only viable architecture. The bottleneck of remote compute is bypassed as logic scatters to the edge. The true winners of this architectural shift are the hardware engineers and operating system architects building the localized edge agent runtime. The future of the tech economy is shifting away from the cloud. It is becoming hard-coded into the localized, sovereign silicon living directly on the user's desk.